If someone receives a letter from the IRS labeled CP90, it can feel overwhelming. The language is firm, the intent is serious, and the clock starts ticking the moment it arrives. The CP90 notice is not just another reminder, it's a formal notice of the IRS's intent to levy assets. That includes wages, bank accounts, or other property in an effort to collect unpaid taxes. But before reacting out of fear or uncertainty, it's important to understand what the notice means and what options are available. Pete Kesey, an enrolled agent who works with individuals and small business owners facing complex tax challenges, has helped many people navigate this exact situation. His approach is rooted in education, clarity, and strategy. Here's what the CP90 is, in plain terms. This notice typically comes after a series of earlier IRS letters, like the CP14 or CP501, that may have gone unanswered. The CP90 is essentially the IRS's final warning before they initiate a levy. It gives the taxpayer 30 days from the date of the letter to take action or respond. Inside the notice, the IRS details the tax debt in question, how much is owed, which tax years it applies to, and the consequences of not resolving the issue. While the language may sound intimidating, there is still time to act, and more importantly, there are options available. Receiving a CP90 doesn't mean someone's bank account will be levied tomorrow, but it does mean the IRS has moved into a more serious phase of collection. In this video, Pete Kesey shares insights into the most common mistakes taxpayers make after receiving a CP90, steps they can take to protect themselves, and resolution paths that many don't realize are available, even if they can't pay in full. For those who want to explore the topic in greater depth, there's a free ebook available in the description, The Ultimate Survival Guide for IRS Tax Issues. There's also an option to schedule a free consultation to get personalized guidance. Next, let's look at some of the most common missteps people make when responding to a CP90 notice and how to avoid them. One of the biggest mistakes people make after receiving a CP90 notice is ignoring it. Whether it's out of fear, confusion, or the hope that it will somehow go away, inaction is the fastest way to escalate the issue. Another common misstep is calling the IRS directly without fully understanding the options, or worse, saying something that could unintentionally limit those options. The IRS agents on the phone are not financial advisors. Their job is to collect the balance, not to strategize the best outcome for the taxpayer. Some also try to resolve the issue too quickly, agreeing to unaffordable payment plans or committing to terms without reviewing their full financial picture. This is where professional representation makes a real difference. Pete Kesey recommends starting with 3 key steps. First, open the letter and read it carefully. Note the date at the top and the 30-day window for action. This is the time to assess, not to panic. Second, gather financial documentation. This includes recent income, expenses, assets, and debts. Having a clear picture of one's financial position is crucial when discussing resolution options with the IRS. Third, get informed guidance. An enrolled agent like Pete can help taxpayers understand their rights and determine whether options like an installment agreement, offer in compromise, or currently not collectible status might apply. Over the years, Pete has helped many clients work through CP90 notices. In one case, a small business owner had received the notice after missing earlier letters due to a change of address. The IRS was preparing to levy the business account. Pete stepped in, reviewed the client's records, and found that part of the balance was incorrectly assessed. He submitted documentation, delayed the levy, and ultimately negotiated a payment plan that the business could manage without shutting down operations. In another case, an individual on a fixed income faced a CP90 for back taxes dating back several years. Pete helped that person file a financial hardship request and got the IRS to classify the account as currently not collectible, stopping all collection activity. Every case is different, but the key is the same: taking informed, timely action with someone who knows how to navigate the system. There are several resolution paths available, depending on a taxpayer's financial situation. Installment agreements allow for payments over time. Offer and compromise may let some settle for less than the full amount owed if they qualify. Currently not collectible status can temporarily pause collection if the person genuinely cannot pay. And in some cases, penalty abatement or amended returns can reduce what's owed. Pete helps evaluate which option makes the most sense based on the individual or business's circumstances. It's not about pushing people into a one-size-fits-all solution. It's about understanding what's possible and protecting what's important. For those facing this situation and feeling overwhelmed, Pete offers 2 free resources designed to help. The first is an in-depth ebook, The Ultimate Survival Guide for IRS Tax Issues, which walks through the types of notices, resolution strategies, and how to prepare for IRS contact. It's linked in the description below. The second is a free online consultation where Pete will review the situation and offer insight into the best next step. That link is also included. There's no commitment, just a chance to get clarity. Dealing with the IRS can feel isolating, but it's a path that many have walked and resolved with the right help. Receiving a CP90 notice is serious, but it's also an opportunity to take control before enforcement begins. With a clear plan and expert guidance, it's possible to avoid levies, reduce stress, and get back on track. To learn more or take that first step, check out the resources below. And if this video helped bring some clarity, feel free to share it with someone else who might need it.